what I'm arguing here, sticky inflation, stronger growth than we expect, is actually a story for earnings and a story for the economy to move along. Although keep in mind that the employment numbers will be low because the supply is down. I'm talking about the US here because of the lack of population growth. And that is for the moment being perceived as positive for equities, even though, maybe rates start up, we'll see. But like I said, the 10-year yield hasn't really done that just yet. And then you throw into that the potential for AI. And people are all thinking that AI, people are thinking that we're going to take middle management out of all these companies and we're going to replace them with a large language model. And then the margins of these companies are going to go up. So even though the valuations are really high, you're okay to pay up for those valuations because AI is going to justify it. Well, we'll see.
Hey everyone, my name is Anthony Fatsies and welcome to another episode of the What the Finance podcast. On this episode, I have the pleasure of welcoming back Jim Bianco. So Jim is the President and Macro Strategist at Bianco Research. So Jim, thanks so much for coming back on the podcast.
Thanks for having me. Looking forward to the conversation.
Yeah, really looking forward to it. And we're obviously at the end of 2025, start of 2026. So where I'd like to start is, when you review 2025, what are the key themes that you sort of were paying attention to and you think really drove what we saw?
I'm going to go with the outlier presentation or the outlier thing that I saw. If you look at the developed country long-term yields, I'm talking about 10-year, 30-year yields, the 15 largest bond markets, only one was lower on the year, and that was the U.S. 10-year. If you look at the 8 or so countries that issue 30 years, including the U.S., none of them were lower in 2025. So we've got this outlier instrument, the U.S. 10-year. It was lower than everybody else. Everybody else's yields went up, obviously. Japan led the way with an enormous rise in their yield in 2025 and is continuing into 2026. So the question is, what is unique about the U.S. that it had the only 10-year yield that fell? Is it growth? Economic growth? Not really. If you look at economic growth around the world, the U.S. is one of the stronger countries. So it wasn't rallying because our economy was weak. There was a lot of weaker economies and their interest rates went up. Was it inflation? Our inflation fell, but we had one of the higher developed world inflation rates throughout most of the year and actually ended the year with it in the upper half. So it wasn't inflation. Other countries had lower inflation and their central banks were hiking rates. Was it supply? Well, we haven't solved that problem. I mean, we still have huge budget deficits and we're expecting bigger budget deficits. So what was it that was unique about the 10-year yield? I've only got one argument for what was unique about it. The President of the United States, Donald Trump, came in and said, judge me by the 10-year yield. If the 10-year yield goes down, I'm doing a good job. And the Treasury Secretary, Scott Bessent, has been redoing auction schedules and trying to set everything up in order to push the 10-year yield down. It worked in 2025. Will work in 2026. Only at this point, I think, if the economic data cooperates. We need to see weaker growth. We need to see falling inflation. We need to see reductions in budget deficits. I don't think we're going to get those. And so I think a repeat of the U.S. being the outlier is probably not in the cards. Now, if our yields go down because we get weaker growth, lower inflation, I think a lot of other countries are going to have that and their yields will go down. Otherwise, all the major central banks, with the exception of the UK and the US, are expected to raise rates in 2026. Raise rates, headlined by the ECB. The UK is expected to cut rates by 25 basis points for the whole year. The US is expected to get more aggressive, largely because Jay Powell is going to get replaced if he isn't put in an orange jumpsuit and sent to jail before his term ends on May 15th. And so if that's indeed where we're going to keep going, cutting rates, we're going to put somebody in who's uber hawkish, we're going to keep working the schedules on auctions to try and get the 10-year yield down, and the data does not support it, I think we could see the U.S. yield snap back quite violently unless something changes.
Okay. Yeah, that makes sense. And then So there's this inflation fear, as you're saying. Is that, I'm guessing that's the main reason that there's expectations that everyone else is going to raise, even though, let's be honest, economic data isn't looking very flash. Employment data, especially outside of the US, employment data isn't looking very good as well. So is it just mainly, the BOJ's obviously got inflation. They have inflation concerns, but I guess the rest of sort of Europe doesn't seem to be as bad, and other countries don't seem to be as bad as well. So what are you thinking for 2026?
Yeah, I think the rest of the world, keep in mind too that the ECB and the Bank of England and the Bank of Japan, they got more of an inflation mandate central bank. So they're looking at inflation. It's above their target, especially in Japan. They've got a real inflation problem. Japan, just so everybody understands, Japan calculates their inflation rate with taxes. They have a value-added tax, or what we would in the US call a national sales tax. So that's included in their inflation rate. If you strip that out, Japan has a higher inflation rate than the US for the first time in 50 years right now. That has not happened since 1977, that we've seen that Japan had a higher inflation rate than the US. And it's showing up in their bond market, and it's showing up in a lot of their economic data as well, too. So, the US is kind of holding out hope that maybe the inflation rate will start trending lower. I don't think it will. That our growth will weaken. Actually, our growth is very strong. But if it doesn't, I think that trend you saw in the rest of the world of higher rates in 25 will continue into 26, and we'll be kind of dragged along with them to go higher as well.
Yeah, really interesting. I guess, I know a key thing that you've been talking about is immigration and the reduction, especially in the US. There's also interest rates coming down. There's also AI trends coming through. So I'd imagine that a lot of these are disinflationary trends, especially compared to what you saw in COVID. There was obviously this high immigration, there was this high supply chain issues, which really was a key driver. So you don't actually have those sort of tailwinds. You have energy coming down as well. So there's all these sort of, there's these tailwinds, not these headwinds, that actually say that maybe inflation comes down a bit further into 2026.
Yes, except for the immigration one. I would say that that's going to be a headwind. Let me explain it, but first let me preface it by I've on your podcast, when you've had me before, and I've said this in many other places, that every time you have a recession or you have a financial crisis, and we had both in 2020, an economy changes. Whether it's a European economy, any capitalistic developed world economy, it changes. And change is not worse. It's not dystopian. It's a little bit different. And ours is definitely a little bit different. And one of those changes is immigration. Now, I'm going to make one other comment about that too. This is more of a cultural comment. I would argue to you that the COVID shutdown, what we did during 2020 with COVID and the shutdowns and the restart of the economy and everything, was one of the biggest economic events of our lifetime. Bigger than the financial crisis, the stock market crash, 87, the Gulf War, take your pick, 9/11, the introduction of the euro, or whatever else you want to argue, it would be up there as one of the biggest economic events. Every one of those other events, books are written about it, movies are done about it, songs are written about it. But when it comes to COVID, everybody wants to collectively forget it, pretend it didn't happen. Don't talk about it. And I've argued that's the problem. That was such a major economic event that we're running into problems by forgetting and not acknowledging it was a major milestone, probably in our lifetimes, what it did to the global economy. Now, one of the things it did was immigration policy. And this is true around the developed world. First, we saw post-COVID a massive influx of immigrants. I'll use the US as my example, but it's the same thing that's been happening in Europe and in Canada and in Australia and a lot of other places. We had a massive influx into immigrants during the Biden years. The four biggest immigration years where we had net inflow of immigrants, mostly undocumented, were the 4 years of Biden in the last 100 years of the US. Then Trump comes in and he slams the door shut. Again, one of the things we don't talk about is what has been his probably most effective policy since he became president. Actually, the day we're talking, January 20th, is a year ago today, he became president. His most effective policy is net undocumented immigration is zero into the US and has been for several months. And most of the country approves of that. Now, the deportations thing is a little bit different. So why is that important? Let's talk about jobs. What is the biggest driver of labor supply? We always talk about, let me back up. We always talk about labor demand, right? Oh, the payroll report came out and the unemployment report came out and this industry or this group saw inflows of jobs and we saw more jobs in construction, less jobs in retailing, or however else we describe it. That's to talk about the demand for jobs. But we never really talk about the supply of jobs. And that, I think, is more important right now. And what is driver of the supply of jobs? It is driven largely by two factors: the population growth of the country and productivity. Now, when we had, I'll use the Dallas Federal Reserve has done a study on this, and I'll modify some of their numbers. But back in 2023, when the border was open, we had floods of undocumented workers coming in. Dallas Fed said that our labor break-even rate was over 250,000 jobs a month. So that when we got the payroll report, we needed to create at least 250,000 jobs a month because we had huge population growth because of immigration. Fast forward to 2025, 2026, net inflows is zero. Net immigration, according to the Brookings Institute, is negative for the first time in maybe a century in the U.S. We might have the lowest population growth in the U.S. We don't have the final numbers in yet for 25, but there's a credible argument to make. We have the lowest population growth in the U.S. in 100 years in 2025, largely because we're below our fertility rate. The baby boomers are aging, so the net birth number is falling to zero, and all of our population growth comes from immigration, and we don't have any immigration right now. So what does that mean? That means that the labor break-even rate might be as low as 12,000 jobs a month right now. And there's an argument to be made, and the Brookings Institute floated this in a report last week. It could be negative by the second half of this year. That if we produce, they say it could be as low as negative 20,000. We could get to a point where we could say, payroll report minus 10,000, better than expected. Maybe the Fed should consider hiking rates. We're not mentally there yet, but I think that that's what's been happening with the labor market, is that we've got low numbers, we're down a lot, and everybody will go through all the demand numbers, how many people are losing jobs, who's not hiring. But the real question is, how many do we need to create? If they're right, and the estimates are right with the population updates of about 12,000 to 25,000, well, the private payroll number, because Doge messed up the government numbers, is around 60,000 jobs a month, right, for the last 3 months. So what I'm trying to argue is most people are looking at the payroll report or the labor market and saying, my God, it looks terrible. We're only producing 40, 50,000 jobs. We've had a couple of negatives in there. And I'm trying to say, if you adjust it for the population growth, it's actually a strong number. And that is really what we've got to get our head around, is that this labor supply number has really changed things. Economists know it. They just don't want to, and they've actually argued it. Ferroli at JP Morgan says it's 15,000, but they don't want to quite go that next step and say, okay, so if we produce 20,000 jobs, we're good. We don't need any more jobs than that. Well, it's fine for the U.S. economy. And so therefore we say, it's 15,000 jobs. We produce 20. Maybe the Fed should continue to cut more. And what I'm arguing is, if you're going to continue to stimulate this economy when it doesn't need it, you could wind up actually stimulating it to more inflation.
I know you say things change and we get evolutions in economies and how they work, but why doesn't it go back to a 2010 scenario where can we have growth with limited inflation and then we just see massive asset appreciation? Can you see a scenario like that?
Yes, I mean, that's always possible, but I don't, because I'll go through the rest of it. So the economy changed in 2020. Deglobalization is a big one. Remote work, giving more employees or labor more bargaining power. If I don't like the terms of your job, I could get another job and I don't have to move. So that gives me more flexibility. the immigration in and then slamming the door shut and the like, and all of the political tension that we've seen, and then you throw in tariffs. And I think that the combination of the economy changed 2020. What changed about the economy in 2020 is that all of those have created frictions and more inflation. Now, inflation rate in the United States since April 2020, that's when the COVID recession ended, has averaged 4.2%. Now it's 2.7 right now. But I'll turn that argument around and say the Fed has an inflation target of 2%. We have been above 2% and as high as 9% for 57 months now. Between 2010 and 2020, we averaged 1.7%. Now we're averaging 4%, and we haven't been below 2% for 57 months. So there is something about this account. We have more inflation. That's really what I'm arguing. I am not in the 8, 10 Zimbabwe camp of the massive amount of inflation. I am in the 3-ish camp, and at 2.7, given that we missed the October data because of the government shutdown, I would argue that we're right at the low end of this. We're not at about to have another leg lower, but I think that we're at the lower end, and we could see inflation bottom out and maybe hold these levels, if not start drifting higher later this year.
Okay, but then I guess in the short, I understand that the driver behind, I guess, wage pressures, and there's going to be, more negotiating power for workers. But then I guess in the short term, you imagine with people actually leaving the country and lower immigration, that could be beneficial for, I guess, property prices, for potentially food, for potentially all these other parts of inflation. Or do you not see that going?
No, I think that over time. Oh yes, we slammed down population growth. You're right. That means, and I'll turn that around. Kevin Hassett has argued, he's the president's National Economic Council chairman and was a favorite to be Fed chairman until Trump nixed that last week, was saying that the labor market's getting set to boom in the second half of the year, and implying that we could see payroll reports consistently of a couple of 100,000 jobs a month. Okay, where are these people coming from? There's no population growth. We have 212 million people in the United States between the ages of 16 and 64. 164 million of them have jobs. 58 million of them don't. Now, who are those 58 million? Well, it starts at 16 to 64, the working age population. So a good 25 or 30 million of them are students, high school students, college students, postgraduate students, housewives, independently wealthy, disabled, military, incarcerated, just don't want to work. 58 million people have said, given the current state of the economy and the labor market, I don't want to work. I will be a student. I will be a housewife, or I can't work because I'm disabled or whatever. Okay. So if you're going to start cranking out a couple of 100,000 jobs a month and you don't have that population growth to support it, you have to entice that 58 million person pool to get back into the labor force. How do you do that? Pay them more money, pay them a lot more money. And that's wage inflation. And that's where it could come. Now, you're right. Over time, won't that free up housing? Won't that lessen demand for food and gasoline? Yes, over time. But, and this gets into the diciness of the actual numbers, a lot of the undocumented workers, the Trump administration says 2 million of them been deported, but the number's probably more like around 400,000. They're still here. They're consuming apartments and consuming food and consuming gasoline. They're hiding maybe because they're afraid of being arrested at work and stuff. So that demand for that stuff with them is still here. They're not seeking employment because the places that they would normally seek employment, they're afraid that they might get arrested and deported. So that will over time wind up being a positive. But I don't, positive meaning pushing down inflation. But I see that as a couple of year to maybe 5-year type of scenario, not it's going to do it immediately.
Okay. Yep. Thanks for explaining that. So, we go into 2026, as you said, Fed, Powell is obviously not going to be the Fed chair in soon. They're going to bring in someone who's probably very dovish, wanting to cut interest rates. And you're saying that could have impacts on, bond markets. Can they sort of just go into QE and try basically almost go into yield curve control, artificially dampen the the yields, or do you think that would cause a massive blowout in somewhere else?
Yeah, they could try all of the above. They could try yield curve control. They could try QE. In fact, you could argue that we're already doing some form of QE where the Fed is buying, they call it reserve management purchases, RMP, and they're trying to say because they're not buying duration, they're buying treasury bills, that doesn't count as QE. I went back to Bernanke's original definition in the portfolio balance channel arguments that he was making in 2010, 2011, and 2012. And he was making the argument that QE, it didn't matter where you bought in the yield curve. It was always QE. So we've been jokingly calling this reserve management purchases not QE, is because I tend to think it doesn't matter if they buy bills or 30-year bonds. It's all really QE. So they could try all that stuff and they could cut rates. But the question is, does the market agree with it? Let's go back to September 24. It was a couple of weeks before the election, about 7 weeks before the election, and the Fed cut 50 basis points. They were worried about the labor market back then. Then they cut November and December for 100 basis points. What did the 10-year yield do? The 10-year yield in September of 24, when they cut rates by 50 basis points, was 3.6%. By January of 25, almost a year ago to the day we're talking, it was 4.8. It went up over 100 basis points as they cut 100. Why? The bond market rejected their policy. You can QE, you can yield curve control, you can cut rates. But if the bond market is saying we got strong growth, we're worried about inflation, and you do that stuff, you're gonna blow up the bond market. And that's effectively what we did a year ago. We went up 100 basis points in 3 months in the 10-year note. So the bond market has to somewhat agree with the policy. And largely it's not, because if you add in the 75 basis points that they've done since September of 25, in the last 4 months, they've cut 175 basis points. Again, September of 24, the 10-year yield was 3.6%. Today, it's 4.2. It's 60 basis points higher, and they've cut 175 basis points. When was the last time the Fed cut 175 basis points and the 10-year yield went up? It's the 1970s. And I would argue for a similar type of reason. You're cutting rates. We disagree with it. We're worried about inflation. I don't want to own your bonds, and yields go up. And so that's the other problem too. The bond market has to be in agreement with them. And it's sort of tolerated what they were doing for the 10-year yield to fall in 25. But I think that for 26, it absolutely has to, the data has to fall in line and the bond market has to agree with it. Otherwise, you're right. They could try QE or they could try yield curve control, but it will not give them the policy outcome that they want, lower 10-year yields. It'll give them higher 10-year yields because they'll have a credibility problem and people will shy away from their instruments.
Yeah, okay. And I'm going to push back again. Sorry, I feel like I'm doing this a lot.
No, please do. It's better conversation.
Yeah, definitely. But so they obviously reduced interest rates, but they kept QT going. So they actually then were sucking liquidity out of the market. So I guess that's another thing you could say. It's like, well, if they were sort of neutral, it'd be interesting to have seen how that would have impacted yields. I don't know if you think that had a massive impact on.
No, it did. It did. We saw that, by the late summer, that the repo market in the United States started to, show volatility, and that the Fed's standing repo facility, which is their, for when there's a demand for more repo, was starting to finally get used regularly, and as well. So it did have an impact, but that impact was largely centered on the funding market rates, repo rates, SOFR rates, tri-party repo rates as well too. It didn't really filter out into the 2-year, 5-year, 10-year, or 30-year. And then they ended QT, and now they're doing reserve management purchases ahead of what the Fed's worried about is they're worried about tax day in mid-April. Is that what happens is everybody who owes taxes, it's the proper incentive to do is you fill out your you finish your taxes now, you could, and you see you owe. So what do? You hold on to it till April 14th and you write them a check on April 14th. And there's a massive outflow out of the banking system in mid-April to the Treasury as people pay their taxes. And I think the Fed has been worried that could spike repo rates, could upset the bond market, And that's why they're doing these reserve management purchases to try and inject between now and, say, March 31st, enough liquidity into the system that massive outflow goes off and nobody notices it. So I don't see that as really being a bond market event just yet, but you never know.
Yeah, okay. But it sounds like you don't see them going too hard in the cutting and the running it hot and all these scenarios where they lose control of the bond market.
Yeah, I think that there's when we talk about what the Fed's going to be like after May, and this gets to my theory as to why Hassett is not going to be Fed chairman. Let me back up a quick history so everybody understands the history. In 1986, there was a Fed FOMC meeting. Paul Volcker was the Fed chairman, and the committee voted on whether or not they should cut interest rates. 1986. Paul Volcker voted no to cut interest rates, but the committee, the 12 members of the FOMC, voted in favor of cutting interest rates. So the chairman, Volcker, was outvoted. He got up in the middle of that meeting, walked into his office, called Jim Baker, the Treasury Secretary at the time, later became Secretary of State, called Jim Baker, or it was the other way around, actually. Excuse me. He was Secretary of State, became Treasury Secretary, and resigned right in the middle of the FOMC meeting. A couple of Fed governors walked into his office, convinced him to come back into the boardroom. They had a second vote, and they voted to not cut interest rates. From that moment forward, the way Fed policy works is that the members of the FOMC between meetings get to argue and make cases all they want to the Fed chairman. A week before the meeting, the Fed chairman decides what they're going to do, and everybody falls in line and votes for it. Now, let's fast forward to December. Because of Trump's attacks on the Fed, and why is he attacking the Fed? Because Trump knows, like everybody else, none of the other Fed members really matter. The Federal Reserve Chairman makes the decision. So if I can get my Fed guy in charge, everybody else is just kind of window dressing. It's not wrong in that thinking. That's the way it's been for 40 years. But Nick Timiraos, who's the Wall Street Journal reporter, covers the Fed, wrote a piece a couple days before the December meeting, and he said there's 19 participants in the FOMC, 12 of them vote on a rotating schedule. If you looked at all of their speeches, 10 of them gave speeches between the October and December meetings. 10 of them gave speeches and said, we shouldn't cut rates at this meeting. 9 of them did. If you narrowed it down to the voters, 7 of the voters gave speeches saying we should cut rates. 5 of them didn't. And the vote came out 9-3. A couple of the voters did not follow through. They gave speeches, said we shouldn't cut rates. And then because the chairman wanted to cut rates, they voted with him. But the die's been set. The Fed is now breaking from that 40-year tradition of the chairman decides, and Fed policy is vote tallying. Okay, Mary Daly gave a speech, put her in the cut camp. Austin Goolsbee gave a speech, put him in the hold camp. Which camp has 7 of the 12 FOMC voters? That's what they're going to do. So Trump recognized that the new Fed chairman has to be a bit of a personality force or a bully, because he's not just going to say, we're going to cut rates today and everybody's going to salute and vote 12-0. He could get outvoted. There's never been a Fed chairman that's been outvoted in the 110 years or so that the Fed's been around, 112 years the Fed's been around. But that's a possibility. And I think the reason that he pushed away from Hassett is qualified to be Fed chairman, very smart, very intellectual, but a very reserved guy. He is not a force of nature like Trump. Well, nobody is like Trump, but he's not going to be somebody who's going to be able to bully the committee into doing what he thinks is the right policy. And that's why I think he pulled them back. I think that they understand that. So what's going to happen after May, I think, is we're going to quickly understand the Fed chairman is not as important as we think. He's one of 12 votes. And we're going to be counting up everybody's speeches and saying, which side of the ledger are they on? So we're going to go into it thinking there's going to be lots of rate cuts because that's what Trump wants. But we'll see whether, who he gets as the chairman. Final thing I'll point out, and I've been saying this for months. I know we have a final four. Was Hassett, Kevin Hassett, Kevin Warsh, Chris Waller, who's an FOMC governor, and Rick Reeder, who's director of fixed income at BlackRock. I've argued of those four that Trump is really looking for door number 5. He being Trump, has been telling us since before Thanksgiving, we're a week or two away from the announcement. I've made up my mind. And we never get the announcement. The beginning of last week, Scott Bessent said, he'll make the announcement before he goes to Davos. He's leaving for Davos tomorrow morning. They haven't made the announcement. Now it's going to be, he'll make the announcement a week or two after he gets back from Davos. The announcement for Fed governor or Fed chairman is perpetually 2 or 3 weeks away. It has been for 2 or 3 months. I think Trump's looking for somebody else. He wants somebody who's got 3 qualities. 1, they genuinely agree with him that the funds rate should be 1% because that's what he believes. 2, they can get through the Senate, committee to be confirmed. And 3, he can trust them. So everybody's got a problem. Warsh is the favorite now that Hassett isn't, but Trump might not be able to trust him. Warsh will tell him, yes, 1%, 1%. And then he gets confirmed by the committee and he goes, now that I see this data, maybe we ought to not do the 1% thing. Letnick or Apolte, they're true believers. Bill Pulte, the head of the Federal Housing Finance Agency, or Howard Lutnick, the Commerce Department head, they're true believers in 1%. Probably can't get confirmed by the Senate. Rick Reeder, maybe he's a true believer of 1%. Trump can't trust him, not because he's not trustworthy, because Trump can't trust anybody he doesn't know. So I think he's actually looking for somebody else. And I wouldn't be surprised if it is a completely different name. And to that end, Scott Bessent threw in, we have 4 final candidates, and he threw Michelle Bowman's name in there. Okay, now all of a sudden we got a new name. Michelle Bowman is on the finalist list, where a week ago she wasn't. So I think that this is what we could be talking about. The way that the Fed operates, how it views things, could be worlds different at the end of 26 than the way we think it is at the beginning of 26, starting with the role of the Fed chairman.
And how do you see this impacting, I guess, the markets into 2026? It sounds like this could be more uncertainty, more chaos, I guess, the Trump chaos that seems to be going around. But then markets did very well last year, majority of markets.
I would argue 2 things. One, I have been very critical of the way that the Fed has worked, that the chairman decides and you get to have a meeting with him 2 weeks before, and he'll put on his serious face and you tell him why he's wrong and he'll thank you for your opinion, but then he'll tell you what they're going to do. That was always the wrong approach. It created groupthink. It created mistakes, most famously in recent years, transitory. The problem with transitory, when the Fed was saying that inflation on its way to 9% was transitory, was not that the Fed got it wrong. I don't know, Powell. I know a number of people at the Fed. There was a number of people at the Fed that did not believe that were worried that inflation was something more than transitory. They weren't allowed to say it. And that's because of the groupthink that comes with the Fed chairman. So I've been in favor of that. Yes, this will create uncertainty, and this might create some volatility as we start to transition to this new way of thinking about the Fed. But ultimately, it's a good thing. And I would argue, if you look at the Bank of England, in August, the Bank of England had a vote. They have 9 voting members to cut rates. And the vote was 4-4-1. 4 to cut, 4 to hold, 1 to cut 50. So they wound up cutting 25. Nothing wrong with that. There's nothing wrong with a 7-5 vote. Monetary policy is an uncertain view of the future. We don't know what the future is going to come. It should be conflict. There should be majority and minority opinions, and you should come to a consensus, not by fiat that one person dictates what the policy is. So yeah, will there be some indigestion in this period of trying to understand it? Absolutely. But in the long run, I think we'll be better off to break from this model that we've had for the last 4 decades, where the chairman just decides what they're going to do. It's not a good model. And I'm glad to see that maybe it's going to go away.
Yeah, and I guess this will, potentially gold and silver will continue to rally in the near term. Potentially, equities could do well as well, but then I guess it depends how long will that last.
Right. So a couple of things on that. So gold and silver, I think, yeah, the uncertainty thing is definitely helping them. Silver is up. Like I said, we're talking January 20th. Silver's up over 30% already this year, and it's only January 20th. Gold is up like 14% this year. And they'll continue to rally. But I think what's really benefiting, just to stick on gold and silver for a second, what's really benefiting them is the worry coming out of Asia, and especially China, and the weakness that we're seeing in their economy. Bear in mind that if you total up the total value of all equities, fixed income, and real estate worldwide, that the gold and silver market is about 3% the size of the rest of those markets, meaning doesn't take a lot of money to move them relative to how much money it takes to push stocks, bonds, or real estate up or down. So if you've got real concerns, the day before we are recording, China reported 4.5% GDP growth, the lowest number in 3 years. Remind you, 3 years ago was zero COVID. 3 years ago, their economy was shut down and people were welded into their apartment buildings because they were trying to get rid of COVID. And I'm not exaggerating. They welded the doors shut on a lot of apartment buildings because they didn't want interaction. And they got the same growth rate now with their economy open. Their economy is in a world of hurt, and there's just no other way around it right now. And a lot of Chinese investors are looking to protect themselves. A lot of other Asian investors are looking to protect themselves. I think the primary driver of the precious metals rally is coming out of Asia. It's not necessarily coming out of Europe or the US. There's some momentum players that are trying to play along with it, but they're not the major driver of it. The major driver of it is the problems that you see with the Chinese economy. Equities, what I'm arguing here, sticky inflation, stronger growth than we expect, is actually a story for earnings and a story for the economy to move along. Although keep in mind that the employment numbers will be low because the supply is down. I'm talking about the US here because of the lack of population growth. And that is for the moment being perceived as positive for equities, even though, maybe rates start up, we'll see. But like I said, the 10-year yield hasn't really done that just yet. And then you throw into that the potential for AI. And people are all thinking that AI, people are thinking that we're going to take middle management out of all these companies and we're going to replace them with a large language model. And then the margins of these companies are going to go up. So even though the valuations are really high, you're okay to pay up for those valuations because AI is going to justify it. Well, we'll see.
Yeah, really interesting to see, and I guess we'll see. I think you mentioned there that the infrastructure that's actually being built, it could be beneficial for the future as well. I think that's one thing. It's even if the AI bubble crashes, it's going to potentially build new businesses that keep going.
Yeah, exactly. So to outline that, just so everybody knows, I am a big bull on AI, meaning, and I'm going to define what that means. Not only is AI coming, but you should want AI to come. We need it. What do we need from AI? In the developed world, in the modern world of 2026, we are so dependent on our computers, and here's my phone, and on our phones to do everything. You cannot function in modern life without a device, without interacting with a computer. Let me restate that. Interacting with the database. Is it easier than it was 20 years ago? Yes. But you have to do it a million times a day. And so it's too much that I got to keep pushing all these buttons to order a latte, and I got to push a million buttons to do this, and a million buttons to order a plane ticket and everything else. It should be to the point where I just push the little microphone button and say, order me a latte, get me a plane ticket to New York, and tell me that the smallest cap stock in the S&P, done. And it drinks ordered. There's your plane ticket in your wallet. And the smallest cap stock in the S&P, I looked this up this morning, is Etsy at $6 billion. All done. Now, I didn't, but we need it all to be done like that because we've got so many other things to do. We have to move on. I can't be pushing 18,000 buttons to do all that stuff. That's what AI to me is going to do. Oh, they argue it's going to cure cancer. Well, yes, to the extent that, and I'll keep the example simple. A researcher looks in a microscope, sees something in a microscope, and then the researcher and their team spend 2 weeks programming a computer to tell them what they saw in the microscope so they can model it out and try modeling it. How about tell the AI, look in the microscope and make me model what you see. There, done in 5 seconds. Okay, great. Now let's run the model, let's test the model, and let's keep moving down the road towards solving or curing cancer, as opposed to constantly coming up with these roadblocks that keep, spending time. Lastly, we need it because of the jobs. I've used the airport. I've been traveling a lot lately. And so much of modern jobs, and my job, your job, a lot of our jobs, what we really are is database operators. We just sit in front of a computer and we tell the database what it is we want to see. And I've used the airport as an example. I go into the airport. Now I want to go through security. First thing is they got to scan me in. Well, that means that they have to see that I'm properly in the database. And if I'm not, I go to the counter and they fix me. Then once I get there, I want to go to the airline club. They got to scan me in. If I'm not properly in the database, they got to fix it. And then I want to go on the plane. They got to scan me in. And my boarding pass has to be properly in the database, or I have to go to the counter and they got to fix it. How about I walk into the airport and AI says, Jim's here and he's got a flight and let him through. Or I walk into the airport. I don't know why Jim's here. He's going to be at security in 17 seconds. We better fix it in 16 without him even knowing that we fixed it. And we have it fixed and he walks right on through. That's what we need from AI. Now, the last thing I'll mention about AI is there's a study done, some studies done. There's, as I mentioned earlier, there's 164 million people in the United States. That AI might eliminate 50 million jobs, a third of the jobs, that they'll become redundant, that a large language model can do it. Like I said, most of the jobs at the airport, they can wind up doing. And that's got people worried. But the history of technology is it's a net creator of jobs. It will create more jobs than it displaces. So I have no doubt that if you're telling me that AI is going to displace 50 million jobs, it's going to create 70 million jobs. Now, why does it create so many jobs? Because business models that were not economic become economic because of this new technology. I'll give you an example. This podcast. Anthony, if you wanted to have this podcast with me and put it on YouTube and make it available to hundreds of millions of people, and let's say it's an hour long, just to use a round number, you would have had to buy NBC in the United States or Channel 5 in Britain, and you would have to spend probably $1 billion. And you would have to set away time on those channels in order to give us an hour to have this conversation and forego or try to sell tens of millions of dollars of advertising to support it. There was no way you could have done this, or any podcast could have done this, without the current technology we have. Now, to do this is pretty much the cost of electricity. In your house in order to do it. We have created whole new industries and businesses that weren't viable because of the technology of the internet. AI will do the same thing. Things that we don't even consider doing because it would just be way too expensive. Driverless cars or automated cars or autonomous trucks, to give one example, will become viable and cost effective in the future. It will free us up from doing the drudgery of making sure that I stand at the counter and fix people in the database so they can go through security, to do something else because it's going to be cheaper, and that something else should hopefully be a more fulfilling job. The last thing I'll say about AI is the concern I have is those 50 million jobs that are lost and those 70 million jobs that are gained is how that happens. If you lose the jobs first, gain the jobs second, there will be a pushback. I'll use another great technological advance from 150 years ago, the Industrial Revolution. When we went from 50% of the jobs, I'll use the United States, in 1900 were agrarian on the farm, to by 2000 it was less than 2%. We eliminated jobs, older jobs first, before we created the new industrial revolution jobs second, people got upset. There was a pushback. There was a pushback against capitalism. The pushback was known as communism. Now, the pushback to AI won't be communism. Communism is a pushback to the Industrial Revolution from 150 years ago, but it could be something like that. In fact, on Silicon Valley, they already had a name for it. It's called the decelerationist. Basically, the argument with AI is you're in one of two camps. You're in the accelerationist camp, move fast, break things, go, go, go. Sam Altman is probably the poster child for just keep going, going, going. Don't worry about this or that. Elon Musk is probably an accelerationist right now, too. He's in trouble because Grok has the spicy mode where you could create pornography and people are upset that they're using people's images without their know-how, somebody and you create pornography with them, and it's a mess as well. And then there's the decelerationist camps. They're saying, time out. We got to slow down because we have to understand what we're doing. Some have even gone as far to worry that this is the next Skynet Terminator thing as well. That could be very well your pushback if you wind up losing too many jobs. So I'm very positive that ultimately we want and we need AI. We just have to manage this transition properly. And if we do, I don't think it will be a problem.
Yeah, really interesting. And it's quite a new take that I haven't heard before. So Jim, thanks so much for your time. Really appreciate it. Last question is, what is one message you want people to take away from our conversation?
I want to go back to what I said earlier, that in 2020, we want to pretend it didn't happen. We don't write books about it. You don't see movies about it. You did about the financial crisis and stuff. Things changed. Things changed a lot. And change is not worse. Don't think I said it was worse. It's different. And between deglobalization, the immigration volatility, tariffs, remote work, and now AI, I think that this is a different economy than it was in 2019. It's not necessarily bad, but I do think one of the things is going to be stickier than average inflation as we transition our way through this. Maybe in the 2030s, we'll get past this inflation problem. I do think we will. But for the next 5 to 7 years, I think it's still going to be with us.
Perfect. Great message. So thanks again. If anyone wanted to find out more about your work and what you do, where would the best place for that be?
Two things. My original day job is Bianco Research. We are a macro fixed income institutional research firm. You can find out about it at biancoresearch.com. I'm active on the socials at Bianco Research on Twitter, X at Bianco Research on YouTube, and Bianco Research, or my name, Jim Bianco, on LinkedIn. The second job that we've taken on in the last couple of years is, because I'm a bond guy at heart, we do manage a fixed income total return index. It's called the Bianco Research Total Return Index. It has its own website called biancoadvisors.com. And if you're on Bloomberg, it's BTRINDX. And there's an ETF that tracks our index. It's with our partners at Wisdom Tree. It's called the Wisdom Tree Bianco Fund, or WTBN. It's for people that are looking for fixed income and how to invest in fixed income. We're offering our way through our index to try and invest with fixed income. We've been doing it for 2 years. We've been very happy with the results. They're detailed in our investor letter. It's pinned at the top of my socials, and you can find out more about it on Bianco Advisors. And you can find out more about the index and about WTBN there too. So thank you for letting me bring it up.
Hey everyone, thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that, but it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching, and see you on the next show. And you also might like this video right here. All right, thanks again.